I'm Chris Spencer. I'm the president of the United Methodist Foundation of Louisiana. We're honored to have you with us today. We have three wonderful guests that will be helping us present a recap of the last 6 months and discuss what to expect for the remainder of 2023 and out into a little bit into a preview window into 2024. I'm pleased to introduce our panel today, the members of our Merrill advisory team. Scott Kelly is Managing Director and Private Wealth Manager and Global Institutional Consultant with the Merrill office. And Junaid Ahmad is a Senior Vice President and Wealth Management Advisor and Global Institutional Consultant with the Merrill office. And Marci McGregor is a Managing Director and Senior Investment Strategist, supporting Merrill and Bank of America Private Bank for the Chief Investment Office within Bank of America. So we're honored to have three wonderful experts, the financial markets and wealth advisory with us today. Scott and Junaid help manage the foundation's investment portfolio and lead the team, the global institutional team that works with us. And Scott and Junaid particularly focus on foundations and other nonprofit entities on the institutional side, and have been wonderful trusted advisors for our clients and for the foundation, and work with multiple Methodist foundations across the system. So at this time, I'll turn it over to Scott. A little bit of housekeeping before I do that. As Scott and Junaid and Marci present, if you have any questions, please type them in the chat box down below. I think it's probably on the toolbar at the bottom of your screen, and we will address them along the way. We'll probably address questions after Marci's presentation, and then we'll pick back up with questions after Scott and Junaid talk about performance reporting on the second half of the webinar. So without further ado, Scott, I'll turn it over to you.
Okay, thanks, Chris. Good to be with everybody, and I'm glad we're doing this now, and we didn't do it like 3 months ago because we've got some markets that have improved very much recently, and yesterday or maybe the day before there was some additional good information about inflation, so that's been a big topic, and with that I really do mean this when we have Marci, who is one of the top people within the Chief Investment Office and is on TV at times and has a lot of great opinions and knowledge, and really one of her biggest focuses is on the institutional group and allocation and then strategy. So it's a real honor to get it direct from Marci. And so with that, Marci, you and I talked, I think we're, very general comments and just about maybe a little bit about where we've been, but more importantly about where you think we may be going. So with that, turn it over to you. Thanks for being here.
Thanks for having me. Thank you for the kind intro. And we actually nailed our timing today for another reason. We just published our mid-year check-in report for clients. So I can talk all about, where we've been coming from, what's changed since the beginning of the year in terms of our expectations for the path ahead. And most importantly, we'll talk a little bit about what to do about it. So the title of the report was Oceans Collide, which, I don't know, it sounds more ominous to me than it is. But what we're talking about is that there is a transition that's going on right now in the economic cycle between an old economic regime and the new regime. And oh, this is a great visual. I'll talk about kind of what the old regime is, what the new regime is like, and what it means for our expectations as we started the year for this kind of mild recession. I keep using the word reset because I think that's what's going to feel a little bit more like that we do think is on the horizon, and how we think about this rally that has been really concentrated, and what that means for the path ahead. So, when we think about the old regime and the new regime, when I think from the global financial crisis until maybe call it 2020, the real kind of hallmarks of that economic regime were, really, really low interest rates. The Federal Reserve either had interest rates at zero or extremely low for much of that time frame. we are, have obviously already transitioned into a regime where interest rates have moved higher. I think generally speaking, in the path ahead, you're going to see higher rates, not higher than where we are today necessarily, but higher than where we have seen them kind of call it over the last, 10 to 15 years or so. Inflation is a similar story. If you think about in the wake of the financial crisis until, a couple of years ago, you had a Federal Reserve that struggled to get inflation to their 2% target. In fact, I think they had 12 years where they undershot their 2% inflation target. They sure solved that problem in the last couple of years. So generally speaking, I think you're going to have inflation that trends, again, not higher from where we are today, but higher from that decade after the financial crisis. So from drifting below 2%, I think generally to above 2%. Now, there's certainly implications to that. When inflation is generally just above the 2% Fed target, that doesn't leave a lot of room for shocks. So if we think about, the El Nino weather pattern that's in place right now, that can cause, shocks to agriculture, grain prices, and in turn, of course, food. Unfortunately, we live in a world with a lot of geopolitical stress, right? That can, as we have seen, cause stress in energy markets and can add, stress to inflation. So generally speaking, inflation that trended below the 2% target in the old regime, and now I think likely the path ahead, even once the Fed stabilizes inflation and gets price stability back, it generally will trend above 2%. The way I think about it is inflation will have a higher resting heartbeat than it's had before. When we look at the old regime, it was one where nominal GDP growth was pretty muted. Generally speaking, we've seen a lot of strength, thanks in part to inflation, to nominal GDP growth. Generally speaking, I think a higher nominal growth will be the way forward in this economic cycle. When we think about markets, equity volatility, it was generally pretty muted once we got past the financial crisis. There was, of course, episodic volatility, and we saw flare-ups, but generally volatility was pretty low. Interestingly enough, so far this calendar year, we've seen pretty muted equity volatility, even with the regional bank stress, even again with a lot of geopolitical stress out there in the environment. Volatility has been pretty muted. I think when I think about the near term, we may see some choppiness, some volatility kind of returning. But generally speaking, I also think we're going to be in a world where volatility just trends higher than where we've seen. And that's because I think Fed policy will be really receding. And that brings me to our last point. In the wake of, certainly during the financial crisis and ever since, you've had monetary policy that was very quick to react, right? We've seen multiple periods where the Fed has taken policy down to zero. We've had two examples of quantitative easing where the Fed engaged their balance sheet and is now trying to unravel that. Generally speaking, once we get to a period where policy is normalized, so the Fed finishes their quantitative tightening, that could be, my personal feeling, I know the House view is that the Fed will stop their balance sheet operations by next spring. I think there's a chance with inflation coming down quickly that could happen sooner, but we'll see. But generally speaking, in the next cycle, I think the Fed is going to be a little less reactive, a little less quick to show up with the punch bowl. And I think that's the way this new economic cycle will look going forward. So what's next? If we look back to where we started the year, it was there was broad agreement on Wall Street that we would see a mild recession in the second half of the year. Now, of course, there's been a few segments of the U.S. economy that have proven to be far more resilient than I think economists gave them credit for. Now, of course, we've seen slowdowns and almost like these rolling recessions over the last year in different parts of the economy. It started really with housing, which of course is the most interest rate sensitive sector in our economy. As the Fed was rolling ahead pretty quickly with interest rate increases starting last year, you saw housing slowing down. And more than anything, what you saw was a market that kind of froze a little bit. I think we have an interesting demographic trend going on right now where you have, baby boomers thanks to innovations in healthcare largely staying in their homes and aging in place. That wasn't possible, a couple of decades ago. We can also, in a glass half empty view, point the finger towards the extraordinary costs of long-term care. So a lot of that is moving into homes. And at the same time, the other end of the demographic spectrum, we have millennials, which are a huge generation in their peak household formation years, in their peak earning years, looking for housing. Now, what's different about this tee-up right now versus, call it the lead up to 0809, is home building has been below trend really since the financial crisis in the U.S. And it's our view that there is a deficit of housing by millions of homes in the U.S. And that's why you're seeing this really interesting balance. You have over 95% of mortgages in the U.S. are fixed rate mortgages, very different in places like the UK, where and very different than where we were kind of leading into the financial crisis. Now, most mortgages are fixed rate. So homeowners that are staying where they are not feeling the impact of the Fed rate increases directly. Now, of course, affordability has changed. If you're getting a new mortgage, a new loan, we're certainly feeling the pinch of higher Fed rates. But what's caused is a housing market that started to slow down. You saw, obviously, inventory has been incredibly low for some time, but we're almost seeing signs of recovery in housing because we're seeing home building perking up. We're seeing new home sales are really strong, even though there's not a lot of existing home inventory. So I see a market that slowed down and then became a little bit more mixed, which is a sign of improvement. If we look at other segments of the economy, manufacturing, that data is clearly telling us that the manufacturing segment of the economy is already in a recession. We've seen a significant contraction there, and it makes sense, right? We're buying less things. If we think about ourselves as consumers, we're spending more on experiences, leisure, hospitality. The joke I always make is even though we've seen domestic airline prices come down, there's still pressure on international flights. Because if you think about in the wake of COVID, it's one of the kind of later activities for us to kind of renormalize. So we're seeing pressure there, and inflationary pressure is still there, but the manufacturing segment of the economy has slowed. Now, of course, we are still seeing a consumer that is really solid. Now, as you know, we have access to a lot of data on the consumer thanks to the bank side of the business and all of the credit and debit card data. Now, what we are seeing is spending has slowed, right? We've seen now a couple of months where compared to last year, we've seen a negative print on retail sales, but it's been quite muted. This is not a big drop off, right? What we're seeing is a consumer that still has the cushion of deposit balances. So compared to 2019, what we see is across all age groups, across all income cohorts, on average, our internal data is showing deposit balances are still 40% above the 2019 levels. So the consumer still has a really big cushion. We're estimating that at the rate that that's getting spent, maybe about 10 months of cushion before they kind of get back to those 2019 levels. Now, the one thing I would point out about the consumer is I'd be remiss if I didn't talk about the return of student loan payments. The lion's share of student loan payments are federal in nature. Those will be returning in October with interest accruing starting in September. We are already seeing, by generation, a reaction there. Now, interestingly enough, it's millennials that hold the most student debt, like that's pretty intuitive, but it's also higher earners that own the most student debt, right? So that's the two cohorts that we're actually seeing tightening the purse strings the most. You're seeing this divergence in spending data. Older Americans are out there spending. They've seen a nice boost in Social Security payments due to the inflation adjustment at the beginning of the year. Younger Americans, where most of those student loans sit, are already starting to tighten the purse strings. On average, the average student loan bill is going to be about a little over $380 a month. So I'm watching that segment of the consumer economy closely. Now, like I said, the consumer's on 2 feet. They have a nice tailwind still from a really tight job market, so I'm not overly concerned. But we could see a further slowdown in the consumer when we get to this fall. And then, I mentioned the labor market. The labor market is still really tight. If you do our job, you're constantly looking under the hood of the data each month to see if there's any significant signs of slowdown. Now, we are seeing jobless claims trending higher, but they're from really low levels. Nothing in the ballpark that would be consistent with a recessionary indicator. So this tells me the labor market is still tight. Personal opinion, I think we are in a structurally tight labor market. This isn't specific to COVID. This isn't specific to 2023. We have a shortage of workers in the U.S. Now, that tells me, U.S. corporations are really nimble. They adjust, right? I think when I think about the next cycle and what drives investment, I think it's going to be automation. It's going to be companies innovating their way out of these labor shortages. But in the near term, the implication of a labor market that's still pretty tight is the Fed's going to keep marching forward. It's our view that you get another 25 basis point rate hike for the Fed later this month, and that there may be one more kind of in the hopper after that. The Fed is telling us very clearly that they are dedicated to their battle against inflation. Now, inflation is coming down quickly. We got consumer price data yesterday, producer price data today. Both showed significant slowdowns in inflation, so that's certainly good news. These are some of the mildest prints that we've seen in a couple of years. Now, the producer price index data was really interesting today because it almost borders on deflation. Now, I think that this inflationary period, if I want to compare it to something in the past, right, we always have to pay attention to the lessons in history. I think it's more like the 1940s than it is like the 1970s. Now, back in the 1940s, if you think about it, you had a tidal wave of spending. It was wartime spending back then, of course, compared to COVID and pandemic era spending. You had a reopening of sorts. And what you had was double-digit inflation in 1947. And then you actually went to outright deflation in 1949. So I actually think that's the relevant example we should be talking about and maybe warning the Fed about. But the Fed is looking closely at the 1970s, and there is another lesson there. In the 1970s, and I guess in the 1940s, you actually saw three peaks, call it, to inflation. Of course, back in the 1970s, because Fed policy was so stop and go, there was all these fits and starts to their rate hikes. Ultimately, it took 2 recessions to bring down inflation. Now, the good news is Fed Chair Powell is acutely aware of that example of the 1970s. I think that's why when you hear his tone, he is so resolute in his battle against inflation. He wants to avoid that mistake of the 1970s. But since what I do is look at data, we actually looked back to what the market did during these peaks of inflation. Of course, a Fed funds rate that got near 20%. The S&P 500 found its bottom in 1974. Now, after 1974, there was another recession and 2 more peaks of inflation. So from 1974, that was 6 years before the last inflation peak and 7 years before the ultimate peak under Fed Chair Volcker in the Fed funds rate. So if you close your eyes and ears, and there was a lot of noise in the late 1970s. If you closed your eyes and ears from 1974 into the early 80s, you actually made money. Now, the market was quite volatile. It was really choppy. And you had to be really thoughtful also, about positioning an inflationary environment. But generally speaking, the S&P 500 climbed higher. And so I think that's a really kind of relevant lesson for today's inflationary pressures. When I think about this market, now we've had a really nice rally, as Scott mentioned, in the first half of the year. And in fact, off of those October lows, it's been actually pretty concentrated. It's been a really narrow rally. It's been really focused on a handful of mega cap tech leaders. And I think there's 2 reasons for that. One, of course, artificial intelligence had its 4th of July fireworks moment where everybody is talking about it nonstop. Now, it's way too soon for AI to be generating real profits, so I'm not expecting this to show up in earnings. But, of course, that doesn't mean that these tech names and the tech sector in general aren't reflecting the enthusiasm around this. The second point I would make is there's a lot of uncertainty around there, right? You know, recession calls have been delayed. It's our house view that we get a mild recession now in the first half of next year. And I did use the word reset at the beginning of our conversation because I think it will feel like a reset to the economic cycle. Remember, a recession is not the end of the world, it's the end of the cycle. That is how all cycles end, right? And we think it, like to my earlier point, it'll be mild for the consumer. While we will see some pickup in unemployment, again, it'll be mild compared to, you know, your average recession historically. But you have a lot of question marks out there, and I think that's also some of how this equity market has gotten so concentrated. You have investors flocking to a few higher quality mega cap tech names that have a nice tailwind. So for two reasons, I think that the equity market rally that we've seen so far has been really concentrated. Now, what does that mean for the path forward? Honestly, it doesn't mean much. We look back at previous periods where the market was this narrow, and frankly, it didn't tell us anything about what comes next. You know, history is pretty mixed on this topic. What I will say, now we're in a technical bull market off the October lows because we rose more than 20%. What I will say is when I think about the next bull cycle, this sustained bull market, when the economy really gets into recovery mode, to me, that's going to be a rally that has much broader participation. The glass half full argument about a really narrow market rally is that if you take out the tech sector, the market's actually flat this year. If you take out those mega cap names, the rest of the market's actually pretty attractively valued. So you could get some catch up there when you think about what the market can do next. So it's our view. So I'm not overly worried about the concentration in the market. Of course, I'd like to see it broaden. That'll be a sign of health in this rally. And I think ultimately the hallmark of the next bull market, when we get back to that rally in a really sustainable way, will be broad participation. So I guess what I'm hinting at here is in the near term, I think we need to stay disciplined. We need to stay patient. The market has to digest a couple more rate hikes. Liquidity is being removed by the Fed, which hasn't been the case in the first half of the year. You may get some choppiness in the next few months as earnings kind of continue to adjust here from their peaks back in 2022. But ultimately, there's a few areas that we're really excited about. We're already talking and thinking about what is this new cycle that the baton is being passed to, or I guess I used the analogy of a bridge earlier between the two economic cycles. There's a few drivers that we're already talking about. You know, the first, I would say, you know, I talked about demographics. It's longevity. That's healthcare, right? That's where a lot of innovation is happening in our economy, in our market. So I think that's a kind of really exciting place that will, you know, driver of the new regime and the new market. The second is a little less optimistic, but unfortunately it's the world that we live in, and that's defense spending. You know, NATO is making a lot of headlines with their big meeting today or this week in Europe. Defense spending, not just in Europe, but globally, is likely to trend higher, unfortunately, due to a kind of red-hot geopolitical backdrop. That's the world that we live in, but as investors, you know, we think about these things. You know, I also talked about, you know, innovation. I've talked about generative AI. You know, I think that certainly is going to be a place where, as I mentioned, corporations are going to be investing in efficiency, investing to work their way through a really tight labor market. When I think of automation, I also think about the big picture trend, supply chains moving closer to home. And then finally, infrastructure, also really tied to that. You know, of course, there was a big spending bill from Washington last year around infrastructure. We won't be feeling the impact on the U.S. economy, call it for 5 to 8 years on that infrastructure bill, but ultimately in the new cycle, that's going to benefit energy, materials, industrials, right? And that's what we think of as recovery. So I'm staying patient. I'm staying invested for long-term growth, for really interesting real yields for the first time in, 15 years. That's why I want to stay invested, but I'm staying disciplined right now. I'm not taking kind of any huge undue risk in either direction. I want to be exposed to long-term growth and real yields, and I want to, frankly, have my shopping list ready for when we start to see the pivot in the cycle. That shopping list may look like smaller cap companies. I think it's too early just yet, but small caps are inexpensive relative to their large peers. to a point that could tee up a decade of outperformance. They're also the domestic suppliers of U.S. multinationals in a world that is moving away from globalization towards more kind of economic blocks for the U.S., for China. Really recently we've seen the dollar weakening. I think it's a little soon, but ultimately international markets, specifically emerging markets, I think will be an interesting place to be in this new economic cycle. Remember, China, while their kind of economic reopening has been a little bit, disappointing to economists, it's been a little bit lackluster, they're not battling inflation. I think they will continue to kind of ease and support their economic growth. So in the, call it the next few years, you have an economy in China that's diverging from the U.S. and Europe, which is slowing. At least right in this moment, China is growing. I think it's maybe enough to keep the global economy out of a recession. And ultimately, like I said, I think it's a little early, but that will make the case for international equities, specifically, I think, emerging markets. So let me pause there. I threw a lot at you all, went around the world and back, and into a new economic cycle. I would love to hear if you have any questions or if there are any topics that are front of mind for us to talk about.
Thanks, Marci. One question we have in the chat is, what is the handicap from the experts on a rate adjustment after the July expected increase by the Fed?
Yeah, absolutely. So our house view is to get 2 more 25 basis point hikes, July and September. Could the September one get pushed towards the fall? It certainly could. Now, I'll say a couple things. One, Fed Chair Powell is doing a really good job of talking a harsh, hawkish game right now. It's a lot easier to sound hawkish now for markets and then act dovish later, right, than the reverse. If he sounds too dovish, financial conditions will ease. It'll work against his goals, and it's a lot harder to reverse that. So Fed Chair Powell is doing the right thing by sounding really hawkish, warning us that this cycle is not over because he can always reverse course. But market expectations have shifted a lot with the inflation data from yesterday and today. There's a little bit of a mismatch right now between market expectations and what Fed Chair Powell is clearly telling us, which is the Fed is saying there's probably at least 2 more rate hikes. The market's not buying it right now. That can cause volatility. It will ultimately resolve itself. One of them will be correct. But our view is 2 more 25 basis point hikes before this cycle is over, and that you don't get cuts until next spring, so spring of 2024. And the last thing I'll say in response to that question is, whenever I hear in financial media a view that we're going to get rate cuts this year, it takes my breath away, because that's not an optimistic scenario. If the Fed had to pivot quickly, just a couple months ago, the market was expecting a rate cut in September. That's no longer the case. But if the Fed had to go from hiking rates in this, aggressive fashion for the last 15 months or so to cutting immediately, that would tell me something's gone wrong. So that's actually not the optimistic scenario. The scenario is that Fed will sit back, digest data, watch the labor market, watch inflation before they start slowing down quantitative tightening. That'll be the first step. They'll start tapering their tightening, and then it would be rate cuts. And I think that's the story for next spring. Thanks for the question.
Chris, anything else that you see?
No, that's the only question we've had so far. It's a great question. Marci, any wrap-up comments? I know we're kind of at the bottom of the hour, so we can pivot here to Scott and Janae to talk about performance. If you have any closing comments, or are you ready to jump off?
I'll give you 30 seconds. As I mentioned, there is a lot of uncertainty. We are transitioning to a new economic regime, which, in my seat is actually exciting. It's a new profit cycle. It's a new economic cycle. But sometimes that transition can feel like a grind. So be patient. You can tilt towards higher quality investments. You want to stay balanced, disciplined, diversified. Things like high quality bonds, which as I mentioned, paying a nice real yield for the first time in quite some time. Higher quality equities right now, while we get our shopping list ready for the new cycle, the new regime, which is coming probably sooner than we think. Thanks so much for having me today. I appreciate all of your time and the conversation.
Thank you, Marci.
Thanks.